In Peter O'Connor from Shaw and Partners. Good morning, Peter. Thank you for joining us. Let's have a quick chat about BHP and Woodside, because obviously oil and gas, hot topic at the moment.
It is. Good morning. It's great to be back. And look, BHP's discussions with Woodside, it's a big news day today and yesterday when it first broke, but it's really a story that's been 3 decades in development. So BHP's been talking on and off about divesting their oil business going back to the 1990s. So this idea is not new, but what's driving the idea is key. So the narrative back decades ago was about realising value. The oil business wasn't realising the apparent value that BHP thought it should. It was about trying to get a window on value and uplift for BHP's share price. Now it's about a different theme. That narrative is decarbonisation. And that's driving behaviours across the big end of the market globally and right down to the small end, as we saw across the 49 companies who presented at Diggers and Dealers just over a week or two ago. Decarbonisation is a key thematic, but at the big end, BHP is certainly looking at a massive pivot over the course of this quarter, part of it being this new news about maybe demerging their oil and gas business, which again has been expected, but it's for a different narrative. And then pivoting that into potash, which has also been well flagged, but that decision to go ahead with that potentially a multi-decade investment is pending over the next month or so. So BHP's, other than the result today, which should be a big set of numbers and a big dividend, there's a lot going on behind the scenes. But oil, key thematic, but it seems like a lot's got to go on to get this deal sorted just yet.
It's a tough one because we still need it, but I think when you've got targets like 2030, 2040, 2050 to decarbonise, it's increasingly on the nose. Is that also behind the Santos oil search? Is we're going to see increasing M&A in order to realise the assets while we still need them?
I think so. It's driving behaviour on both sides. So those that are looking to divest, which is the major miners looking to decarbonise, but also to satisfy their ESG credentials of investors globally, and those that are in that space, the energy space, so the oil and gas, LNG producers, and even coal, looking at how do I adopt to this future where I'm on a slippery slide over potentially 1, 2 or 3 decades before our carbon units aren't used anymore. So in the oil and gas space, it's about bulking up, but it's about bulking up into the right areas and where you can be greener if that's possible in that space. So as you said, Santos Oil Search and Woodside potentially with BHP is just to that end. They need to get significant, but also look at the makeup of their portfolio and where it can be greener going forward. So more moves like this will no doubt be underway, but today's BHP's result and the announcement potentially about this Woodside deal, it's a major point for BHP.
Just staying with BHP, I mean, we all know that no one expected iron ore to be over $200 as long as it was. There's rivers of cash probably coming from the result later. Is that the peak for BHP?
Yeah, look, thinking about where was the peak was 12 May, if you want a precise date. That was the day when China jawboned commodity prices and started to talk down this whole tight thematic that was pressuring them. So the iron ore price peaked that week. And since then, we've seen a slide in iron ore price. Equities haven't yet fallen because they're factoring in these large dividends that you mentioned from their cash they're generating. But iron ore price is down 33% so far from that 12 May peak. And the slide from here, albeit it'll be choppy, but it's certainly heading lower as new supply comes on. And particularly with the most recent China data confirming a trend of recent months, which is the pulse of financing has slowed. And that pulse very closely correlates with commodity prices. So we've seen steel slower, commodity price across the board should track that as well. So yes, I think the term peak, it's been used a lot as well of late, be it peak earnings, peak share prices, peak commodities, but it's certainly looks like iron ore price has seen its highs. And if you think about the period we've been in, it started back in 2019 in January with a Vale incident at a tailings dam. We've seen the peak in May this year, and we're on perhaps a 1 year or 18 month journey lower to a more normal price, which is certainly below $100. So some way to go to normalise in iron ore yet. So peak earnings, peak dividends, yes, certainly.
And just to round out, you've just initiated coverage on Regis as a buy high risk. What is the element of Regis that makes it a buy?
It's cheap. It's the cheapest stock in my coverage universe, in the totality of my universe, across the metals, the energy, and also the gold space. It's also the cheapest gold stock. It's attractive in that it's got that value angle. It's got gold price leverage both ways, but what's really caught my eye is the growth rate that it's got going forward after a major transformation in 2021 with a grew their current resource base at their existing asset, added via a well-timed acquisition a new asset, potentially come another development in New South Wales this year, and it's seen them step up their production profile about 40%, 222 and 221, and out to 2025 they've got a sector-leading gold production growth profile, and who would have figured that just over a year ago? So leading production from the sector, costs and margins in line with their peers, balance sheets in shape, and it's cheap. So gold needs a tailwind, gold equities need a tailwind. It feels like with the reflation trade unwinding more broadly in the market, gold will catch a bid again, having fallen sharply from June. So on that basis, Regis is one of the key picks in the gold space for me.
Fantastic. Peter O'Connor, don't hear cheap much these days, so thank you for the update there, Shaw and Partners.